Welcome to another episode of the Crypto Exchange, a Troutman Pepper podcast focusing on the world of digital assets. I'm Ethan Ostroff, the host of the podcast and a partner at Troutman Pepper. Today I'm joined by my colleagues Addison Morgan and Trey Smith to talk about part 2 of our year in review series regarding digital assets and DLT in 2023. And today we're going to focus on the CFPB and the FTC and spend most of our time talking about the CFPB's recent proposed rule under its larger participant authority and its impact on digital asset financial services companies, and then some digital asset related enforcement actions brought by the FTC during the past year as well. Wanted to just start by contextualizing. I know, look, guys, I think it's obvious to everyone in this space how much hand-wringing there is and worry about the impacts of the CFPB's proposed rule. I think it's helpful in talking about that to go back to October of last year when Director Chopra gave a speech at the Brookings Institution at an event on making America's payment system work for a digital century. And I was looking at that and reminded that, the director did say back then and forecast some of the things that I think are really important when we think about what happened in 2023. In particular, right, they are worried about consumer harm that could be caused by private currencies and payment systems in the household and retail context, right? And so Chopra mentioned a number of different steps that he had identified as warranted, and just want to touch on a couple of those real quick because I think all of them are going to be relevant for our discussion about both the CFPB and the FTC. So the first thing he mentioned was, and he described as an effort to reduce harms resulting from hacks and errors and unauthorized transfers, right? The CFPB's looking at providing additional guidance to people in the market to answer questions regarding the applicability of the Electronic Funds Transfer Act with respect to private digital dollars and other virtual currencies, right? That's sort of one of the things he mentioned. A second was, in the context of forecasting the proposed 1033 rule, he mentioned policymakers, legislators, and regulators need to continue to identify additional financial privacy protections that go beyond the Gramm-Leach-Bliley Act and the protections in that act. And as he said, he thinks they're totally insufficient and thinks that he and other federal regulators need more tools from Congress through federal legislation to deter consumer abuses. And then finally, and I think this will bring us back into this proposed rule defining a market for general use digital consumer payment applications, right? He said he thought it was appropriate to look at the authorities he has at the CFPB to conduct supervisory examinations of non-banks offering consumer payment platforms, and thought the CFPB has more than one authority or basis for authority to do so. He mentioned when non-banks are offering consumer payment platforms in the context of being service providers to depository institutions. And he also mentioned specifically defining a larger market participants by rule. And that's, I think, what we're going to focus on today in our discussion of the CFPB. So, Addison, just to sort of lead into the talk about the proposed rule, my sense is it asserts that digital assets are funds subject to consumer financial services laws, regulations, and would subject large players to supervisory exam processes that are just like banks and other financial institutions. So effectively, maybe wondering if you think otherwise, but to me, it effectively extends the CFPB's supervisory powers to companies that facilitate crypto asset transactions and takes the position that digital applications that facilitate certain transfers of crypto assets will also be included in the market definition of larger participants. How do you see it?
I agree, Ethan. As you stated, the Bureau's characterization of the term funds, right, which is undefined within the Consumer Financial Protection Act and the Electronic Fund Transfer Act, the Bureau's broad construction of that term definitely encompasses digital assets. And I think they specifically state that in the proposed rule. This is a direct quote. Crypto assets, sometimes referred to as virtual currency, are one type of digital asset. And so, the rule is somewhat complex, but yes, high level, I agree with you that it definitely encompasses both the facilitation of those digital asset transactions and the activity of possibly hosting, consumer account credentials, whether that be in the form of a digital wallet or the form of, a traditional bank account or credit account.
I mean, this rule in itself is procedural, right? I mean, effectively, in the sense of defining the digital payments market and then identifying a threshold for larger participants, right? Is that sort of how you see it as well?
Yeah. I mean, it's procedural in the sense that the CFPA does not grant the Bureau explicit authority to regulate digital asset financial services companies. So they're leveraging, kind of this grand discretionary caveat within the CFPB to define this market, right, as falling within the scope of their supervisory powers. And so, yeah, it's procedural. And from that standpoint, definitely.
When we talk about, defining this market, how is the CFPB going about defining it? And are there particular things about their approach to defining the market that, in particular, digital asset companies in the financial services space should be focused on?
Sure. So yeah, the market definition itself, right? And so, because this rule is multifaceted. The market definition itself defined as a market as providing a covered payment functionality through a digital application for consumers' general use in making consumer payment transactions. And so, within that market definition, there are three relevant kind of sub-definitions that the industry at broad should be aware of. So you have covered payment functionality, larger participant, and then you have consumer payment transaction.
I guess as I understand, a consumer payment transaction here would be defined to include digital assets that have monetary value and are readily usable for financial purposes, right? P2P or consumer and merchant transactions where there's the use of a digital asset would fall within the rule unless some exclusion applies. Is that effectively how you see it as well?
Yeah. And so, there goes that term funds again. And we can just move to the consumer payment transaction kind of sub-definition within the broader market definition. And so that term is defined as the transfer of funds, right? And so, this entire rule hinges on, the Bureau's construction of that undefined term funds. So the transfer of funds by or on behalf of a consumer physically located in the state to another person, primarily for personal, family, or household purposes. And so, although this rule seems to encompass a lot of the activities that digital asset financial services companies engage in, you still have to ensure that the type of transactions that you're facilitating are actually fall within the scope of that rule, right? And so there are a few caveats that the Bureau mentioned in the proposed rule. That fourth element that I mentioned, that the transaction has to be to another person. Let's say, for example, a digital asset exchange, is providing accounts to consumers, but, consumers have multiple accounts on this exchange, right? If a consumer sends digital assets to another wallet owned by the consumer, I don't think that transaction would fall within the scope of this definition, right? Because the Bureau states that element requires that a transfer be made to another person besides the consumer. So,
this rule is going to encompass stablecoins as well, right? It's something that's sort of clearly been relevant and increasingly important in the digital asset space, and something that's top of mind, on the Hill as well.
Yeah. Agreed. We can just get into it now. I think, as you know, Ethan, from the plaintiff's bar is utilizing the EFTA to kind of bring cryptocurrency and just digital asset-based litigation. The EFTA also does not define the term funds, as I stated earlier. And so, whether the Bureau's definition holds muster into the future, only time will tell. But right now, the Bureau believes literally all crypto assets, fall within the scope of that term. So yeah, to your point, stablecoins definitely do as well.
In that regard, listeners of our podcast may remember you and me and one of our other colleagues, Carla McCrory, talked about on a podcast last year about these two cases coming out of the same federal court in New York about the question of whether or not digital assets constitute funds under the Electronic Funds Transfer Act, these judges in those two cases actually came out, on opposite sides and disagreed with each other. And as I mentioned earlier, that, that's something the director specifically mentioned when he talked to the Brookings Institution last October was not just finding a hook or a foothold in the space through defining larger participants in the market, but also through what we expect will be additional guidance under the FTA and Reg E. So, I guess, do you have a thought about, sort of at the foundational level, what's the legal predicate to give CFPB jurisdiction all over crypto assets? It sounds like what you're saying is, and I agree with you, right, that digital assets are funds. The CFPB's view is there are multiple different avenues for them to get crypto assets or digital assets covered under various different definitions of funds in various different federal laws and regulations.
Agreed. So, just from a high level standpoint, the Bureau technically doesn't have an explicit statutory basis for bringing these claims, right? I assume this is Chopra's argument, right? This is his perception of what the CFPA permits the Bureau to do. This larger participant rulemaking authority is fascinating because, it's a very powerful provision. It allows the Bureau to dictate which non-bank entities are subject to its supervision, within parameters, right? There still has to be notice of proposed rulemaking, comment period, et cetera. But that provision is very powerful. And so, to answer your question, there is no explicit statutory basis, but the Bureau's point seems to be that there are several financial products and services that the CFPA does permit the Bureau to regulate, and digital assets are similar to those. And so the Bureau believes that because of that, they can also regulate this space. The Bureau can regulate financial products or services like providing payments or other financial data processing products or services to a consumer by any technological means. In that little phrase right there, I could see how the Bureau can make an argument that digital assets fall within the scope of the Bureau's kind of unwritten authority, if you will. But, ultimately the courts will decide whether or not the Bureau is permitted to advance this definition of funds.
Yeah, the way I see it is, there's lots of different hooks under Dodd-Frank for the CFPB to use for its jurisdiction, one of which is engaging in deposit-taking activities, transmitting or exchanging funds, or otherwise acting as a custodian of funds, or any financial instrument for use by or on behalf of a consumer. And to me, the key word there is fund. And the CFPB is simply equating, and I think in its rulemaking, in many pages, like significantly more pages than is typical when you compare this rulemaking to define larger market participants with the other ones we've seen historically, right? Took many more pages in an attempt to do this without really any applicable legal authority, right? But they're focused on funds and equating crypto assets as funds, sort of generally at a 50,000 foot view without really any attempt to parse out the various many different types and just sort of conflating the entire broad universe of crypto assets as funds under Dodd-Frank and saying, because crypto assets are funds under Dodd-Frank, as a result, they are covered consumer financial product or service under Dodd-Frank. Is that how you see it as well?
Yeah. And to your point, we haven't discussed the covered payment functionality like sub-definition within that broader market definition. But yes, I think it's on footnote 64 and 65 of the proposed rule where the Bureau states that, hey, these functionalities are in fact consumer financial products or services. And I think, like to your point, Ethan, they have, a litany of footnotes and, several pages of discussion because they know, or the Bureau understands that this argument has to be substantiated because there's no actual express basis for the Bureau kind of evoking supervisory authority over this industry, and so, because that was my initial thought as well. Well, hey, the Bureau can only regulate consumer financial products or services. I think it's still kind of up in the air whether digital assets constitute a consumer financial product, but the Bureau says they do.
The definition of funds transfer functionality and wallet functionality are so broad, right, that potentially they bring non-custodial wallet services within it. That's how I see it. Do you agree with that?
Yeah, I agree. And so that definition really just encompasses a digital assets exchange facilitation of a transaction on behalf of a consumer. On the other hand, the wallet functionality definition is more interesting because I think here the Bureau is more focused on, kind of the proposed rule mentions tokenization, right? That buzzword that we all know has some basis in the DLT space. But I think here the Bureau is most focused on products like Apple Pay, where you have a tokenized version of your debit card or a tokenized version of your credit card. And through that, you can now facilitate these kind of secure payment transfers to merchants. I'm sure we're all familiar with Apple Pay. And so from a wallet functionality standpoint, I think the Bureau was focused on that, right? The definition is defined as stores account or payment credentials included in encrypted or tokenized form and transmits, routes, or otherwise processes such stored account or payment credentials to facilitate a consumer payment transaction. And so, I'm not sure whether that applies to digital wallets because there are no payment credentials like you stated earlier, Ethan. Although the Bureau's definition of funds seems to apply broadly to all digital assets, including NFTs, including other things that may not facilitate payments. As we know, digital wallets can transfer a wide variety of assets. And so I don't know if the Bureau was directing that definition to digital wallets, but in any event, it definitely does apply to the digital asset exchanges because if you think about it, these companies usually have the capability to store a consumer's bank account information. If a consumer is trying to top up his account via funds from his bank account, well, I think that would be the payment credentials that the Bureau is focused on, those kind of traditional payment credentials. So just something to think about there.
I think it also could include storage and processing of private keys, right? In the context of wallet functionality as well. Just like, accepting and transmitting payment instructions could be viewed to include transmitting payment instructions to a blockchain. Do you see it differently?
I don't necessarily know if I see it differently. I tend to agree with you. I think I'm more so focused on like, what's the Bureau's current understanding of, a concept like private keys, right? Can we say today that the Bureau's understanding of, or the Bureau's discussion of payment credentials, like includes private keys? I agree with you that theoretically it could, because that's a broad-based term, but I don't know based on what was discussed in the proposed rule, whether or not the Bureau currently intends to kind of go as far as bringing digital wallet developers and companies into the fold as well. But yeah, I tend to agree with you from a theoretical standpoint.
If I remember correctly, right, the proposal even states that covered persons don't even actually need to ever hold the funds, right? In addition to the idea of the definition of funds being so broad that, like we mentioned, all of a sudden digital assets are brought within the scope of the FTA and Regulation E and GLBA and other types of laws, which I think helps transition us, Trey, to talking about some regulatory enforcement activity by the FTC in 2023. We did see an increased activity. Following up on that AMG Capital decision that dissolved the FTC's authority to impose civil monetary penalties under Section 13B of the FTC Act, the FTC's been looking for a sufficient substitute for this ability to impose civil monetary penalties. And it seems like the FTC has found at least one hook it wants to use, which is the Gramm-Leach-Bliley Act, or the GLBA. Generally prohibits entities from obtaining financial information from consumers through any false or fictitious or fraudulent statements. But, as we saw in the FTC's case against Celsius Network, the FTC is taking a very broad view of how the GLBA can apply to any misrepresentation an entity makes during a transaction in which a consumer presents payment information. So, Trey, can you talk us through a little bit about what was going on in this enforcement action against Celsius, and some of our listeners should be thinking about and taking away that activity last year?
Absolutely, Ethan. So for the listeners who don't know, Celsius is a consumer-facing cryptocurrency platform. It offered customers a number of different cryptocurrency-related services, and in a lot of ways, it sort of acted like a bank would. Specifically, they offered this earn program to customers that promised an annual percentage yield to customers who deposited cryptocurrency with the platform. It also offered a borrow program, quote unquote borrowed, that allowed customers to take out loans that were secured by their crypto. And then they offered, of course, typical cryptocurrency marketplace, exchange services, custody services, et cetera, et cetera.
What was the enforcement action about? What led to it? What was the FTC concerned about? And what are some of the interesting details or takeaways?
Yeah, so the FTC was principally concerned about the misrepresentations that they allege that Celsius was making to its customers and to the public in general. The company sort of positioned itself as this alternative, safer alternative to banking that promised it would make secured loans to these sophisticated and safe counterparties to earn high amounts of return on customer deposits. They also made a host of representations about the safety of those deposits in terms of the customer's ability to withdraw them or the insurance policy they had with respect to those deposits. But ultimately, at least the FTC alleges, were misrepresentations and were made specifically with the purpose of inducing those customers to deposit funds onto the platform. And so that's sort of where you're seeing the FTC kind of seize on finding that hook that we've been discussing to bring their enforcement action, looking to the GLBA and the CEO statements that were essentially made to procure or to sort of induce customers to give their information that's specific to another financial institution. And we also saw the FTC using its traditional authority under the FTC Act to bring the enforcement action.
So do you guys have any take on or thoughts about the FTC's usage of the GLBA to impose civil monetary penalties in this situation and implications for digital asset companies in the financial services space?
I mean, it's clear that the federal agencies are sort of seizing into whatever hook they can to bring these enforcement actions. So, how I would sort of perceive this trend is to view these regulators' activities as sort of looking at industry participants as traditional banks or as credit unions. For example, Director Chopra, he spoke about industry using the lack of clear regulations as a means of engaging in regulatory arbitrage. And I think that statement is telling because lend credence to the idea that these regulators view the digital asset industry as falling within their respective enforcement authority, but for whatever reason, they just have not found a way to regulate them as yet. I'm sort of implying that traditional financial regulation of this space is inevitable. So I think these enforcement actions are just symbolic of that future.
I agree with Trey. I think, ironically, these enforcement actions in which, the regulators are quite literally searching the deep depths of their authoritative power to kind of reign in this space, I think it just legitimizes the space. And so to Trey's point, these companies, as we kind of predicted, are being regulated like the traditional financial institutions. And I think, we obviously can't see the future, but I think that this trend in terms of leveraging existing financial services laws to rein in the space, I think it will continue. We already seen it with the EFTA. I'm sure that litigation trend will continue to proliferate throughout the year, especially with the Bureau's proposed rule that, in a sense, also implicates the EFTA. And so whether Congress will step in, and create a defined regulatory regime in which, it chooses to delegate authoritative power to one or many of these federal agencies remains to be seen. But I think there has been enough consumer harm, fraud, and scams that these agencies want to step up and do what they can to level the playing field, so to speak, on behalf of consumers.
Yeah, I mean, look, I think Gary Gensler and two of the other 5 commissioners of the SEC certainly agree with the view that existing financial services laws and other types of financial laws can be applied as is to this space, right? And it seems like to some extent there are multiple federal regulators who agree that they have existing tools and laws that they can use. and tend to disagree in some regards about whether or not they need Congress to give them more powers. But it's a very interesting usage of the GLBA and something folks in this space need to be aware of, clearly. So the other enforcement action I thought we might briefly touch on in our remaining time today is the October 2023 consent order of one of the large digital asset financial services companies. Also involved allegations about misleading the customer base by implying that digital assets deposited on the company's platform by consumers were protected by insurance offered by the FDIC. Trey, Addison, what's your take on this case and these claims about FDIC-related misrepresentations and some of the other things that folks in the space need to be aware of based on this consent order?
So I think that the company's advertisements about FDIC insurance were a close call. Obviously, the FTC disagreed and thought that the advertisements themselves were deceptive. But I think that for industry participants that are engaging bank partners to develop some sort of platform where consumers can have access to a traditional bank account, but through that bank account, you can also access digital asset liquidity, because that was the product the company was offering here. Companies who engage in those practices just should make sure that they don't conflate FDIC insurance as being applicable to both fiat cash balances and digital asset balances, because I think that ultimately was the FTC's point. But I'm sure the company, what they were trying to suggest was that, hey, any USD, so fiat cash balances, that we are holding on your behalf is being maintained by our banking partner who is permitted to offer FDIC insurance. But the way some of the advertisements were worded, I could see how a consumer could assume that, hey, it seems like this company is offering FDIC insurance for both fiat cash balances and our USD stablecoins, which is the form of a digital asset. The companies did not make that differentiation very clear. And because the company is not an insured depository institution that even has the ability to offer FDIC deposit insurance, the FTC dinged them on that. And so in the future, I think companies that engage banking partners for these digital asset kind of checking deposit account partnerships, they should just ensure that their disclosures related to FDIC insurance are specifically attributable to the banking partner itself, make that disclosure very conspicuous, but also very clear.
Trey, I don't know if you have any thoughts about this, but, to me, the FDIC has been very clear over the last, 12 to 24 months about its concerns with the way companies in the digital asset space are referencing or representing any type of coverage by FDIC insurance and are significantly scrutinizing that, right?
Yeah, Ethan, I'm inclined to, of course, agree. What both enforcement actions kind of have shown is that federal agencies are concerned with representations that are being made to consumers, because those representations, whether they relate to, the business practices of the company or the safety, these things, the soundness of their practices are factors that are market differentiators for consumers. And these enforcement actions sort of just show that when these representations are being made, that there's significant consumer harm here. And so, I think the FDIC, the FTC, all federal agencies that are primarily concerned with consumer protection are going to kind of seize up on those statements that have to do with safety.
Right. I think, to me, one of the high level takeaways from 2023, particularly when you're talking about the CFPB and the FTC, is that there is a heightened scrutiny by these regulators because they believe they've got to step up to address consumer fraud, harms, et cetera, to retail customers of companies in the digital asset space, right?
Yeah, Ethan, that's right. I completely agree.
Same.
Yeah. Well, thanks, guys. I really appreciate y'all joining us today and hope our listeners enjoyed the second part of our multi-part series covering the 2023 year in review. Don't forget to visit our blogs, consumerfinancialserviceslawmonitor.com and troutmanpepperfinancialservices.com, and subscribe so you can get the latest updates. We look forward to speaking with our listeners again next time when we'll talk about state-level legislation and regulatory events from 2023, and appreciate everyone joining us today.
Copyright Troutman Pepper Hamilton Sanders, LLP. These recorded materials are designed for educational purposes only. This podcast is not legal advice and does not create an attorney-client relationship. The views and opinions expressed in this podcast are solely those of the individual participants. Troutman Pepper does not make any representations or warranties, express or implied, regarding the contents of this podcast. Information on previous case results does not guarantee a similar future result. Users of this podcast may save and use the podcast only for personal or other non-commercial educational purposes. No other use, including, without limitation, reproduction, retransmission, or editing of this podcast may be made without the prior written permission of Troutman Pepper. If you have any questions, please contact us at troutman.com.